Despite economic challenges, Nigeria remains an important investment destination in Africa. The National Bureau of Statistics indicates that the total value of foreign investment that came into Nigeria last year was almost $100 billion. The growing role of domestic investors is likely to lead to more demand as well for alternative asset classes. But what is the most popular investment vehicle through which investors take positions in different industries? Does private equity help to catalyze much needed industrial activity, or will public capital markets or capital investment remain central to sustainable economic growth? Well, joining me to discuss further is Labi Williams, partner and managing director at Kuramo Capital, an independent investment managing firm. Great to have you here today with us.
Thank you, Rolika.
So I saw a recent report from the Africa Private Equity and Venture Capital Association that said a lot of funds are being invested into venture capital, followed by infrastructure and then private equity. And my question to you is private equity still relevant for the business ecosystem in Nigeria?
Well, thank you for having me on again. I think that's a great question, Rolika. From where we sit, we do see private equity continuing to play a very valid role in the development both of Nigeria's economy, but also the wider African economy. The various asset classes are dependent on each other in a way, where you see venture capital backing young companies that feed into the private equity cycle down the line. But I'd also say, what private equity and infrastructure funds do in helping develop companies, telecoms, power, aviation, roads, also do things that help boost productivity for VC-backed businesses. So there's really a very symbiotic relationship between the two. And you also see private equity as providing liquidity to family-owned businesses, which is not what you traditionally see venture capital firms do, and providing those sort of exit opportunities where families or long-term shareholders in much larger, typically much higher cash producing businesses are looking to step back from those businesses, and we continue to see that as a very valid thing private equity would do, as well as bring in much larger sums of capital for individual investments, typically which you don't see VC venture capital do as much.
Yeah, and looking at private equity, if you look at 20 years ago, it wasn't something that was quite well known or very common as a viable means of fundraising. Yeah. But you now have funds that are raising hundreds of millions of dollars in investment into companies in Nigeria and further afield. So what are some of the emerging sectors we're seeing as being attractive for private equity?
Yeah. So, you're absolutely right. 20 years ago, it was a very nascent sector. I joined the industry in Africa about 16 years ago. I think would say early on, you saw themes where early investments were tended to be made in the banking sector, mobile telephony, telecoms, fast-moving consumer goods. We've seen those continue to be mainstays, but also newer sectors come in, healthcare, education, technology, and even within that, some of the subsectors, you're seeing very heavy interest in spaces such as data centers, where you're seeing hyperscalers coming into the African market. Typically, those would be players like an Amazon, a Facebook, Google, needing to host data locally to increase speeds and service to their various, millions of customers around the continent. And it's a trend we've seen play out across various continents. So it's one we're also very excited about.
Yeah, and for new entrepreneurs, typically you have your angel investors, then you have venture capital, and then you have private equity. What sort of time horizon are we looking for companies to be able to tap into private equity markets? How long or how well established do you really have to have been in your sector?
Yeah, typically, a traditional private equity business, if you look at the US market, tended to be focused more on buyouts, where you were acquiring majority of businesses and giving liquidity to existing investors. The companies were already generating very solid cash flows, so you didn't need the capital for growth. In a number of instances in Africa, we're seeing capital needed to drive growth in businesses and sometimes also provide liquidity. Typically private equity has invested in firms that tended to be at least 10 to about 20 years old, historically, that have had that track record of capital growth in their businesses and a track record of revenues, dividend paying. But we've also seen players step back to look at some earlier stage businesses, typically already generating some cash flows or have proven their concept, but a little smaller. I mean, along the lines of your question, we've seen also a lot of foreign private equity firms came into the market. They were typically much larger funds and looking for what I'd call maybe more mega deals. And at that, I'd say, investments of $100 million or more. But again, with where our economies are, those deals tend to be more few and farther between. So we've seen some pull back there, but at the lower level, and again, sub 100 million, a lot more activity in the private equity space.
Yeah, and one of the things that I often wonder is part of the time horizon of a traditional private equity investor. You want to be in there for quite a number of years, but we've seen quite a lot of short cycle investments in private equity in Nigeria. Why is that the case, really? Because the assumption is private equity, you put in your money, 10 years down the line, maybe you look at an exit.
Yeah, well, 10 years down the line, so your funds are typically structured for 10 years. But within that, you're typically looking at the first 5 years to make the investments and an additional 5 years to exit those investments over the 10-year fund life. Typically, you can extend those funds for another 2 years for about a total of a 12-year life. So on average, you're looking to be in these investments for about 4 to 7 years from beginning to end for each investment in the fund. That said, the appropriate thing as an investor is to always have an open mindset to be available for sale should the opportunity arise. And in instances, we've seen, potential exit opportunities for assets that
What are some of these exit opportunities?
They're typically a combination of ways you're able to release liquidity for your own LPs, your limited partners who back the funds. One primary way is selling to a strategic. So that's a company in a similar line of business, whether in the same country, whether Nigeria or another, or coming in from another country that wants to expand into your area of operation. So you've got those as exit opportunities. Sometimes you have what are called secondary opportunities, where one private equity firm will acquire the stake another private equity firm has in a business. And then in some instances, you'll see the private equity firm sell their shares back to their shareholder partners they've been in alongside. And also the IPO market is also sometimes a route, though typically not for exits for various reasons.
And certainly because of the depth and relative illiquidity of our public markets on the African continent, it's always been a difficult exit option. But I want to ask you about some of the macroeconomic challenges we've been dealing with.
Yes, yeah.
Inflation, interest rates, the exchange rates. And then I want you to juxtapose that against returns expectations of investors. To what extent has the current market really impacted returns in private equity?
Right. I think, if I step back and look at the globe and what's been happening around the world, I'd say the rest of the world is starting to look a bit more like the emerging markets. They're dealing with similar inflationary pressures, interest rates being raised extensively after over a decade of very low interest rates. But in our markets, we're used to dealing with this. Of course, they do impact your returns, especially because a lot of the foreign capital investment comes in as dollars, and you're expected to return dollars to your investors. And your investments typically are generated in local currencies in the markets you're in. That said, you're typically looking to make double to triple your capital. You want to make a lot more, but at some base level. And those have seen some impacts, but there are also creative ways to look to boost that, both with driving direct growth in the businesses, in the markets they operate in, potential exports, and also, depending on whom you sell to, you're sometimes able to get a premium for the valuation of the business.
Yeah, and looking at, the issues around the exchange rate. Yeah. So as an investor, if I wanted to exit my business, I might take in an additional risk. Is that increasing my transaction costs of structuring that original investment? Because now I'm converting to dollars or trying to convert to dollars to take the capital out.
Yeah. So, it really, so for a seller, you have to consider your long-term views, your desires of what you plan to use that capital for. So you'll see, you'll have some conversations with investors, and you put a valuation in front of them, and they say, well, at that rate, I'd rather just keep my business and keep enjoying my dividends regardless of what FX does. And in some instances, they're open to doing a transaction despite where the FX rates are. And that itself, there are many factors that compound this. Linked to, if I bring in here even the Jackpot syndrome, both family.
This is the phenomenon of young Nigerians leaving the country.
Absolutely. And Nigerians, but we could as well include, business owners with children who've been expected to take over as the next generation, who may choose to stay outside of the country or leave to do things outside of the country. And so that sometimes precipitates a sale or a liquidity event for a family. So again, FX would not necessarily be a consideration. The way I like to think, FX is always there. It's always something we will deal with. But nevertheless, we have to press on ahead with what we do and try to find the creative and most innovative ways to do that, and selecting the right investments with the right partners, the right growth strategies, and making optimal exits at the appropriate time.
Yeah, interesting how the environment is forcing a readjustment of strategy, coping mechanisms, if you like. So
absolutely.
You obviously run a private equity fund, and you're going out to raise money from limited partners. What are some of the demands they are now making around where fund managers put their money? What are some of the emerging trends you're seeing?
So we're at our core, we do a lot of private equity. We see ourselves as an alternate asset manager. So we also do some venture capital, back in venture capital managers and infrastructure. But with regards to themes, we continue to invest across these asset classes. We're seeing an increasing focus on climate finance, to help the environment with renewables, recycling businesses. We're also seeing some of the energy transition, where moving from, to more cleaner fuels, including gas. A bigger focus on, diversity, including backing female managers or female-owned businesses across the continent. But these are things we've always, had near and dear to us, even businesses we're involved in. But those are some of the key themes we're seeing.
And I guess we'll talk a bit more about regulation after, but clearly regulation has been something that we've seen consistently being implemented in Nigeria in terms of new policies. How do you see that impacting the market?
Yeah, for my approach, and as I've been a student of public policy, even as an undergraduate, I believe, regulation is to aid the market, to protect investors, especially, less knowledgeable investors in a way, who are maybe less experienced in what they do. But ultimately, you're looking to drive an economy, pull many people out of unemployment or sub-employment, and, grow your tax base, grow your industrial base to really drive GDP growth. And, you don't want regulation that impedes that. So you want to be in a position to be decisive on transactions, get them closed on time, while ensuring, the appropriate rules are followed.
Fantastic. It's so great speaking to you, Labi. Thanks for joining us.
Thanks so much, Rolake.
Thank you.